The JSE All Share Index is up 248% in the past 10 years. Or you can look at it this way, it's 13.25% a year. Now, more than double the average inflation rate for the period. But after this magnificent run for local equities, storm clouds are starting to gather. The South African economy is virtually stalled. We're seeing China growth slowing, and also there's a strong dollar that is definitely wreaking havoc in terms of a lot of the emerging market economies. But to join me to make sense of all of this and talk about the outlook and the possible opportunities for investors is Warwick Lucas. He's a Chief Investment Officer at Galileo Capital. I'm also joined by Andrew Dittberner, Senior Investment Manager at Cannon Asset Managers. Gentlemen, thanks for your time. Warwick, let me start with you. We quoted those numbers in terms of the performance of the Aussie, and we have seen the JSE All Share perform very well. The question is this likely to last? Can we continue on this upward trend?
Look, South Africa has a history of being an outperforming equity market. I mean, our long-term equity risk premium is about 6%, which is generally a superior number in the global context. However, looking at that performance, yeah, I mean, it has effectively outperformed that number to some degree. I do think our local market does look a little bit rich. However, it's important to bear in mind that the top end of our index is very concentrated. It's perhaps half of the capitalization is in 6 or 7 stocks, which include a global brewer, a high-flying Chinese internet stock, a Pan-African telecom stock, global luxury goods producer. So this is a very concentrated portfolio and very global in its outlook. So, you know, when you talk about the South African market, one needs to actually perhaps step back and say, well, what are we actually talking about here? And in the most case there, we're talking about very glamorous high flyers, highly rated with fairly high earnings growth. So it boils down to a question of perhaps the index and the rest.
Andrew, let's pick up on that. Warwick said it's looking a little rich at the moment. The price to earnings ratios there, maybe South African markets are a bit expensive. Do you agree? And if so, where else can you go?
I agree to a certain extent. I think, you know, if you look, as Warwick just pointed out, you know, if you look at it as a market as a whole, it does look expensive. However, I think, you know, if you actually go into the different sectors, subsectors, I think there is definitely opportunity within there. You know, the obvious case in points that Warwick pointed out, you know, have done exceptionally well over the past 5-10 years. But if you actually look over the past year, the market's actually flat. Earnings haven't really gone anywhere. In the long term, earnings is what essentially drives share prices. You know, obviously short-term fluctuations or sentiment will drive that in the short term. But in the long term, what we're looking for is companies that can earn or deliver earnings growth, sustainable earnings growth. So there's definitely opportunities within the markets. You've got resource-facing companies. Master Drilling would be an excellent case in point here. Okay. That's a business that's in the business of raise boring or drilling holes for mines. That's not a miner per se, but you know, here's a company that's very profitable. You know, doesn't sit with a huge amount of debt. It's got fantastic IP or intellectual property, and it's definitely not expensive. Not on the valuations that when you look at the market on a PE of 18, 19 times, these sorts of businesses trade at substantial discounts to that.
Warwick, Andrew spoke about sentiment that's driving the South African markets. Couple of factors at play here. You've got China, you've got the US Fed, there was Greece not so long ago, and it seems as though maybe that third bailout may work out. So given everything that I'm throwing at you, which is the one that we are most exposed to, or is it all equally very important at the moment?
I think the China factor is very large in our market, but I think there is a sense of prevailing caution. And if we look at the high flyers, what they tend to all have in common is that they are very defensive industrials with high earnings growth. Anything that is remotely cyclical and has put out slightly weak earnings has been absolutely hammered. So we've had this big dichotomy in the market where the likes of commodity players have been very weak. Banks have performed well recently, but on a slightly longer track haven't performed that well, possibly because of issues or concerns around financial services. And then you've had the likes of SAB, food stocks, pharmaceuticals, massive outperformers there. And a lot of it is a case of well, we're worried about everything else, so this is where we'll go. And you're coming to a bit of a Minsky dilemma here, where stability has been where everyone's gone, and they're so busy chasing stability that they're actually at risk of creating instability. And that, I think, is my key worry about these markets.
Another key worry this week has been around currencies. So the devaluation of the Chinese currency, the stronger dollar that's come in. How do you position yourself given all of this? You mentioned master drilling in the resources facing space, but given the currency situation, what do you do now?
I think if you're trying to forecast currencies or position your portfolio to take advantage of a currency either appreciating or depreciating, I'd put my hand up to say that we don't know where currencies are going, and I'd suggest you're going to get it wrong. So to try and figure out what's going to happen around currency movements, it's a guessing game. You might as well put a frog in the middle of the table and try and guess which way it's going to jump. So, when we're looking at portfolio construction, we want to try and focus on things that we understand, focus on things that we can, with a reasonable sense of certainty, say, X, Y, Z is going to happen going forward, and then we'll focus on valuations. As long as we buy in businesses that are not overpriced, that haven't been pushed up through this sentiment, like your Chinese-facing internet stocks and those sorts of businesses, as long as you can buy businesses that have a reasonable earnings runway and aren't expensive, I think that puts you in good stead. I wouldn't try and trade this market or try and make a quick buck out of it. Trying to time the market's also a mug's game. If you can be in for the long run, buy a decent company on decent valuations with good earnings prospects, and ride out the volatility that we've been through over the past year and will probably continue to go through, I think you put yourself in pretty good stead to manage your way through the current economic dilemma that investors find themselves in.
I'd want to come back to you with regards to the decent company, but first I want to talk about asset allocation that you mentioned. Given the fact that interest rates are going to come up. We don't know when the Fed is going to raise those interest rates, but it's been said September is going to happen. So given this, what do you do with your portfolio? Do you go cash heavy? What?
Right. Well, in terms of the local interest rate cycle, the consumer is generally pretty much dead on their feet, and there's not a lot of business confidence. So the cycle that we're looking at is, I think, not going to be a particularly steep one. I hope. Obviously, one of the concerns around the rand is that it is a commodity currency, and wherever commodities go, there too goes the rand. So if we had further fallout in commodities, that might push the SARB into the corner that it would have to hike rates a bit more aggressively. But at this stage, I don't see that as necessarily being a factor. For that matter, the devaluation of the yuan that we saw has also, I think, taken some of the pressure off the Fed as well. I think they now have that much more free hand not to hike. And at this stage, I would say you're probably back below 50% likelihood of a Fed hike in September. So that too, we don't have to take as a fait accompli.
We've heard what Warwick had to say, 50% chance now in terms of interest rate hike, but you mentioned good quality companies. People always say good quality companies. How do you pick them? Because I asked about asset allocation, so now if I'm a person that's investing, what boxes need to be ticked? What defines a good company?
I think if you start looking at the management, if they've made good decisions historically, if they've allocated capital prudently, that gives you a good sense of, you've got a well-run business. Do they have a moat or competitive advantage? You can look at the returns that they've earned over 3, 4, 5 up to 10 years, and have those returns been in excess of the cost of their capital. If they've managed to do that, I think you've probably found a company that has a moat or competitive advantage, and that's well run. And there I think that's a recipe for a really great business or investment. And then you just got to go and look at the price and make sure that the expectations aren't too high, and hence the valuation isn't stretched. If you can get those three things, I think it puts you in a good position. Yeah.
Warwick, what about offshore possibilities? There seems to be a rush for Europe at the moment, the property sector to be more specific. Is that where your feeling is in terms of value seeking or growth seeking?
Yeah, I think from the point of view of actual diversification of the portfolio, I mean, as Andrew said, you know, mucking around with with currency forecasting, totally a mug's game. One of the nice factors about both the likes of Europe and, for that matter, Japan, is that they are commodity importers. So they're nice hedges for a South African-based portfolio. The other factor is, of course, that they are both in a state of quantitative easing, and although those economies are hardly roaring along, a formula of going from bad to less bad is actually very attractive. So, notwithstanding the fact that in taking a decision to go there now with the rand where it is, you know, exposes you to some potential regret on the currency side. I still think that there's actually enough juice to be squeezed out of both of those lemons that they're still worth going to.
Gentlemen, thank you so much for coming in today. Hopefully your viewers got some really good insight in terms of crash-proofing their investment portfolios, and of course, Andrew, those three things that you said they should look out for. Thanks to Warwick Lucas. He's a Chief Investment Officer at Galileo Capital, and Andrew Dittberner, Senior Investment Manager at Cannon Asset Managers.